You say enough is the day you will see change. You cannot change your life unless you change something. Like Theo Vaughn said, nothing changes unless something changes, man. I mean, who are you? Who do you want to be? And what are you going to do about it? Be hungry, be starving, be unsatisfied with any accomplishment, bro. Want more for yourself, dude. Commit and change your life. It's very likely you and someone else out there share the same exact dream. Imagine if you went one on one, one versus one against them. Are you going to allow them to win and take your dream? No, absolutely not. Fuck that. That's our dream, bro. And that's how you have to wake up every single day. Wake up, go harder, and get better. Now, imagine if that one on one against that person is yourself, that person in the mirror. You want to be better than your past self. You want to beat yourself, right? You want to be better. I like to say 1% better each day is 365% better each year. We're going to cover what I believe is the number one ICT trading strategy. But really quick, I want to talk about overconfidence in trading, how it can destroy your account, and how to control it. I actually struggle a lot with overconfidence in trading. I truly do believe that I am really confident in my approach, and my overconfidence leads me to steer off of my risk management plan a lot of the time. And my journaling pretty much tells that for itself. But what I like to call it is a trading demon. All of these psychological emotions and things that interfere with our trading that I talk about throughout this video and past videos, I call them trading demons. Okay. So, overconfidence, it's one of the biggest psychological traps in trading. It occurs when traders overestimate their skills, like myself. They ignore their risk management, like myself, and they take excessive risks after a winning streak or a few successful trades. This often leads to poor decision making, over trading, and major losses. Overconfidence is the tendency to believe you can't lose after a winning streak, take bigger risks because past trades were successful. You ignore trading rules and enter trades impulsively. You increase lot sizes excessively to chase higher profits, over trade because you feel in sync with the market, and assume your analysis is always right and refuse to adapt. And while confidence it is important in trading, overconfidence it leads to excessive reckless decisions that can wipe out weeks or months of profits in a single bad trade. Overconfidence is dangerous in forex trading because cut that part out. Overconfidence is dangerous in trading because it leads to overtrading. After a few wins, traders they feel invincible and start taking trades that don't fit their strategy. They think they can predict the market and they trade excessively, okay? And the solution to that is just to stick to your predefined trade limit per day or week to avoid unnecessary trades, and always trade based on your strategy, not your emotions. Secondly, it causes over leveraging and increased risk. A lot of overconfident, did I say risk? Increased risk. Overconfident traders increase their position sizes after winning trades. A single bad trade with high leverage, it can wipe out multiple winning trades. A solution to that is to keep your risk per trade constant, 1 to 2% of your account. Never increase your lot size just because you're winning. Follow a structured growth plan, okay? Third, it makes traders ignore stop losses and exit rules. Overconfidence, it makes traders think they can outsmart the market. They hold losing trades too long, believing the market will come back. The solution to that is to always set stop losses before entering a trade, no exceptions whatsoever. If you find yourself removing stop losses, recognize that it's overconfidence taking over, okay? And then fourth, it leads to emotional decision making. After multiple wins, traders they trade based on feeling rather than logic. They ignore their strategy completely and enter impulsive trades. A solution to that is to ask yourself before every trade, does this trade fit my plan or am I just feeling overconfident? You want to stick to structured rules and avoid emotional trading, okay? Five, it creates unrealistic expectations. Overconfident traders, they start expecting every single trade to win, and that's not true. Everybody loses in these markets, okay? They become frustrated and they revenge trade and when they lose. Revenge trading is another trading demon, okay? Solution to that is to accept that losses, they are a part of trading. Think of it as a part of doing business, okay? Even professional traders, they lose, okay? Focus on this long-term consistency, not these short-term wins at all. Now, how do you identify if you're overconfident in trading? You may be experiencing overconfidence if you increase your lot size dramatically after a winning streak, start trading without checking confirmations or setups, feel like you know exactly what the market will do, ignore your stop loss or move it further away, overtrade because you believe you're in the zone, and you may feel invincible and think, I've mastered Forex after a few wins, okay? Recognizing these signs early, they can prevent major losses due to reckless decisions. I mean, I've been kind of flaunting a little bit. I kind of suffer with overconfidence in trading. I'm not gonna lie, you guys. I really need to check myself before I wreck myself. You know what I'm saying? So, how to control overconfidence and stay disciplined? You want to stick to a fixed risk per trade. Never increase risk percentage based on winning trades. You want to keep risk consistent, 1 to 2% per trade, even if you won several trades in a row. Okay, an example, if you like normally risk 1.5% per trade, don't suddenly start risking 5% after a good day. That'd be way too random. That's ridiculous, okay? Second, you want to set a daily and weekly trading limit. Overconfidence, it often leads to over trading, which leads to mistakes. You want to limit yourself to a maximum number of trades per day of the week, okay? Per day or week, even. And then an example of that, if your plan is 3 trades per day, you want to stop trading once you reach that limit. Even if you feel like you can win a little bit more, stop trading. You want to treat each trade independently. Just because you won 5 trades in a row doesn't mean the sixth one is guaranteed to win. Okay. Every trade, it should be analyzed objectively without any emotional bias. A solution to that is to remind yourself that each trade is a new probability game and past wins, they don't guarantee future success. And fourth, you want to journal every trade and emotion, right? Writing down your emotional state before, during, and after a trade, it helps detect any overconfidence. And reviewing your winning streaks, even seeing if overconfidence led to losses after big wins. Example, if you notice that your biggest losses happen right after winning streaks, it's a sign that overconfidence is affecting your trading decisions. And then five, you want to take breaks after a winning streak. Winning streaks, they create this kind of euphoria, making you prone to these mistakes. Taking a short break after a winning streak, it helps reset your emotions before you continue trading. A solution to that, if you like win multiple trades in a row, step away from the screen for 10 to 15 minutes before taking another trade. This is if you made it in the same day, right? And then remind yourself that the market, it is unpredictable. No trader, no matter how skilled, can predict the market 100% accurately, okay? Forex, trading, crypto, stocks, all of it, it's a game of probabilities, not certainties, okay? Maybe news and things can manipulate and whatnot, and good things in the economy can manipulate, but at the same time, it's still a game of probabilities, okay? And after a few wins, you want to tell yourself, the market does not owe me anything whatsoever. I'm going to stick to my system and I will not get reckless. So the goal, it's to shift from overconfidence to disciplined trading to ensure long-term success. Some final thoughts on mastering overconfidence in trading is overconfidence, it's a silent account killer. It makes traders abandon their trading rules, they take excessive risks, and ultimately they lose money. Key takeaways is to keep risk per trade consistent, don't increase after wins, set a trade limit to prevent over trading, treat each trade independently. No trade is guaranteed to win. Use a trading journal to monitor your emotional bias, and then take breaks after winning streaks to reset those emotions, and always respect the market. It can humble anyone, okay? By controlling overconfidence and staying disciplined, you can protect your capital, maintain consistency, and you can build long term profitability. All that being said, I hope that gives you some insight into overconfidence, how it can destroy your trading, and how you can control it. If you got some value from that, drop a like down below. Now we are going to jump straight into what I believe is the number one ICT trading strategy. Let's bring it up. All right, so we got USD JPY pulled up. I like to consider myself more of a swing intraday trader, but these days, as I grow more and more mature in these markets, I really truly do prefer to swing trade. I don't have to worry about news, these lower time frame noise and fluctuations. Every single candle has to do an open, high, low close or an accumulation, manipulation, distribution, aka the power of three. I know, a lot of gibberish, right? That's what's really cool about these markets, as you learn these key terms and it sounds really cool to talk about. It's awesome. Anyways, so what I like to do is I like to start on the weekly time frame. The weekly time frame, it is my bread and butter time frame. This is going to provide me so much directional bias, and it's going to allow me to know what the daily and the 4 hour time frame are likely to do, and then I could scale into like the 15-minute or the 1 hour if possibilities arrive, right? So what I like to look for is external range liquidity to internal range liquidity first on this weekly time frame. So markets, they move in one of three ways. They can either expand, retrace, expand, retrace, expand. In this situation, it's going up, right? This is going to be a bullish market. Or it can expand, retrace, expand, retrace, or expand. And in this situation, this is a bearish market. Bullish means going up, bearish means going down. Okay, bulls, bears, right? So the third one is price can move sideways, where it's not really making any movement whatsoever. It's kind of just going back and forth in a range or a consolidation, right? It's not really having any tremendous up movement or down movement. It's just going back and forth, okay? In this scenario, we don't look for any trading situations whatsoever. We want to see price break out of this and start showing us some directional bias, which is going to be something like this or something like this. Now that you know bullish versus bearish is what we're looking for specifically, internal range versus external range is what we start off with on the weekly time frame, okay? So whenever price, let's say it's going bullish, right? It Whenever price expands, this would be an expansion, and then after an expansion, price can get tired, take a little break, and it'll have a retracement, right? And then it'll be like, all right, I'm ready to go again. Boom, it'll expand, okay? Put me in the game, coach, type shit. And so right here, whenever price is in an expansion phase, it's expanding towards external range liquidity. External range liquidity are past highs or past lows, okay? And then internal range liquidity is whenever price retraces. I'm going to take a break, coach. Take me out the game real quick. Let me get some water. It's going to retrace into a internal range liquidity, which is going to be a premium discount array. That's a very special term for either fair value gaps or order blocks. Or thirdly, is a turtle soup. Now, I'll get into all of that. So, a fair value gap is whenever there's a little gap in the market. Let me show you what that looks like. Notice how candles, they have these wicks, right? Each candle has these wicks, and then they have like their blocks, their bodies and whatnot, but they have these wicks, okay? So keeping that in mind, notice how between this wick and this wick right here, it creates a gap in between them, okay? Again, right here between this wick and right here, it creates a gap, okay? Price oftentimes what it does is it doesn't necessarily create gaps. You can see right here between these candles, notice how there's no gaps or anything between the wicks, right? There's no gaps anywheres in between here whatsoever. All the wicks, they overlap. See how like these wicks don't overlap. See how this wick didn't come all the way back down here, or this wick didn't come all the way back down here like these ones did? So that gives you an idea of a gap, okay? Fair value gaps. Fair value gaps happen when price is expanding with displacement towards a certain direction. What is displacement? Displacement is like these bigger candles. Think of it like an elephant jumping into a really small pool, right? If an elephant jumps into a really small pool, all the water inside of the pool is going to splash out tremendously as compared to like a little infant baby dropping into the pool. It's going to splash out very little. It's not even going to splash out really, right? It might make little baby waves, right? So displacement is going to be like that elephant. There's these little tiny candles. Look at, see how this candle, this is like the little infant baby jumping into the pool. But this big candle right here, this is that elephant jumping into the pool, and it's creating a gap in the market. This gives you a little sense of direction with the order flow, okay? But that's the first one. The second one is an order block. An order block, so whenever price is expanding higher, right? What it's doing is it's closing over down closed candles, right? So down closed candles are these red candles and up closed candles are these green candles, right? So whenever price is closing above, and this is a perfect example, price is going up in this area, right? See how price, there are these down closed candles right here and price closes above them? Well, this becomes a little order block, these down closed candles, okay? So if I draw from wick to wick out over here, this is an order block and price can potentially come into this area eventually. But instead, what does it tap into? It taps into that fair value gap. Boom, boom. See how there was no overlapping of the wicks in this area? Instead, it created a gap. And this is where price expanded, retraced. I got tired, coach. Take me out the game. All right, coach, I'm ready. Put me back in. Expansion. All right, coach, let me get another break. Retracement. See, and whenever it retraces into internal range liquidity, which is going to be these fair value gaps or these order blocks. And the third one are going to be these turtle soups. So turtle soups are like external range liquidity, swing highs and lows, but they're within that internal range. So like if I look for an example right here, let's see if I can find one real quick for us. Mm, let's see if there's one going on at current price. Roll this out. So this is what I consider like a turtle soup, okay? So price was expanding, took out external range liquidity. After that expansion, we expect the retracement. It retraced into this down closed candle, which would be a order block. It also retraced into this fair value gap, and then there's this fair value gap even lower. Now I call these levels areas of sensitivity. Now at areas of sensitivity, we look for reversals. However, we can't know for certain if price will reverse. Price can continue going bearish. It can continue down, right? So what else did it go for? It went for this swing low right down here, right? And this I consider a turtle soup low. The reason why is because price in my mind is bullish within these areas. During the retracement, it's not so bullish. This is a bearish retracement, obviously, based off of hindsight. And we're going to treat it bearish because when price is retracing, it's bearish until it reverses bullish, then it's bullish again. Okay. But right here, it taps into that turtle soup. And at the same time, it's tapping into this weekly fair value gap. Again, these are just areas of interest where we can find some sensitivity in these markets. And we have no idea if they're going to hold. Price can continue selling off from these areas, but we can look for reversals potentially. So from the weekly, we drop not to the daily, but to the 4-hour time frame. Okay. So we go into the 4-hour time frame. Now, those candles that we were looking at were weekly candles. Each candle was 1 week. Now, these candles we're looking at, each candle is a 4-hour candle. So 4 hours, then another candle opens in another 4 hours, another candle after that in 4 hours. So there's a lot of 4-hour candles within one weekly candle to give you that perspective and that, idea right there. But right here, this is that turtle soup that happened right here. Okay. Turtle soup happened. And what I like to look for is I like to look for not only just the turtle soup, oftentimes there's like some other area of sensitivity like this fair value gap that will print in price where right below the turtle soup price will have a reaction from, right? So right here, as soon as it taps into that fair value gap area, we're going to look back and we're looking for 3 candle wick swing highs. I've talked about it in previous videos. It's these candles with the wicks where it has a high wick and then it has a lower one to the left and a lower one to the right of it, right? And so that makes it a 3 candle wick swing high. And what we want to see is every single time a new one gets created, we have a new one created right here, then a new one gets created right here, the new one gets created right here. What we want to see is we want to see a beautiful displacement close over that and show us a change in the state of delivery, a market structure shift where new bullish PD arrays, fair value gaps, and order blocks are being created, and old bearish PD arrays, old fair value gaps, and order blocks are being disrespected. Okay. But in this scenario, it closes above, but it doesn't close above this candle right here. I would want to see it get disrespected so it could close above this sequence of down close candles, aka this little order block right here. And that to me would become a breaker block, but it didn't do that. So I do not consider this a market structure shift or a change in the state of delivery or anything like that. I need to see more of an expansion to take out this high and maybe even close above this bearish fair value gap. Okay. But instead, price comes lower, it creates this high, creates this one, creates this one. And then boom, price close above this one. And it also created this bullish order block right here, right? We could draw it out from wick to wick. Boom, boom, boom. And right there, we have a change in the state of delivery. We have a breaker block. We have price closing above bearish candles. We have a market structure shift right here. We can look for entry upon this. Boom. Stop loss below there. And then we could drop to the 15-minute and we can look for scale in and we can look for another market structure shift bullish. The same thing we just did on this 4-hour, we do on the 15-minute. Look for a market structure shift bullish to continue higher, and we'd look for a second opportunity on that, right? Target 1 to 2R, beautiful setup hit. But from here on, as soon as that market structure shift happens, it comes down, it respects that breaker block, and it carries on. From this point on, that weekly time frame now becomes bullish, and every weekly candle should expand higher. See how these candles were expanding lower? They were having these open, high, low, and then closing, open, high, low. And what I mean by the open, so each candle has this open, it has an opening time, and then it creates the high of its wick, and then it'll expand low and it'll create the lower end of the wick, and then it'll exhaust towards the end of the candle, and then it'll close off. So candle, open, high, low, close off, and then open, high, low, close off right here. This candle opened, it went high, and it made a small low, and then it closed off like right here. The next candle opened high, low. So now that the 4-hour has market structure shifted bullish, we can anticipate, excuse me, cut that part out. So now that the 4-hour has market structure shifted bullish, we can anticipate that these next weekly candles are going to be open low to create the low wick, and we're going to look for opportunities to get in on those lows to catch the low wick, to then see it expand, and that's where we'll catch profit. Okay, and so from here on, we're seeing price go from this area, and the next targeted area is going to be like this fair value gap. We have a tiny gap right here. Whenever it comes here, we can look for a 4-hour market structure shift bearish. If it doesn't market structure shift, we hold the bullish bias until we tap into the next one, which was going to be like this up close candle. This is going to be a bearish order block now. Okay, if it doesn't have a market structure shift within that area and it continues past it, the next area of interest for me is going to be this swing high up here. Boom. Right? Gosh, that's an ugly line. I gotta stop using that. It's this swing high up here. Okay, so we could be bullish until we tap into these areas, and we can remain bullish until we have a 4-hour market structure shift bearish. Now that the 4-hour is market structure shifted bullish, we can now see daily down close candles be respected, tapped into, like right here, for example. See how after the market structure shift happened, retracement, expansion, and then look at how it tapped into that daily order block right here. So over here, that daily order block was created. It expanded through it, tapped into it twice. At those points, we could look for a 1-hour market structure shift bullish because it's a daily PD array. So if it's a weekly PD array that it's tapping into, which is going to be, again, the external range liquidity or the internal range liquidity, fair value gaps, order blocks, turtle soups. Anytime it's tapping into one of these areas, if it's on the weekly time frame, you drop to the 4-hour, look for market structure shift. If it's on the daily time frame, you drop to the 1-hour, look for market structure shift. If it's on the 4-hour, you drop to the 15-minute, look for the market structure shift. Do not ever go any lower than that. You will wreck yourself. Okay, don't do it. But with all of that being said, you can see that it tapped into that order block and it started expanding higher, right? This was like, we tap into it here. This is the 3 candle wick swing high right here. Then we have another one created here, another one created right here. And you can see that price closed above it, right? We can consider that a market structure shift bullish. It took out external range liquidity though, okay? Whenever it takes out external range liquidity, it retraces into internal range liquidity. We could look for this order block or this turtle soup, right? But it continues against us. And losses, again, they do happen in the markets. What did it retrace into though? It retraced into this low over here. If we jump to like a 4-hour or even a daily time frame, right here and right here, I bet you, I guarantee you, that's going to be a previous 4-hour candles low right there, or a daily low, right? It's actually a 4-hour on this one. So with those, you consider that a turtle soup. And because that's a 4-hour turtle soup, you drop to the 15-minute and you're looking for a market structure shift bullish. And look at, watch, right here, it taps into it right here. Look for the 3 candle wick. Where is it? We have it, the H up here at the top. Look at the price number. For this green candle, the H 148.555, 148.555. These are equal highs. So the middle one becomes the 3 candle wick swing high, okay? So whenever price closes above that, look at that. That's a displacing candle. This is an elephant jumping in the pool for you right here. That's displacement. Look at that fair value gap that gets created. Look at how it closes above these down close bearish candles right here. Look at how it disrespects this bearish fair value gap right here. It is a change in the state of delivery market structure shift. It had that breaker block created right there as well. Dude, this is beautiful. This displacing candle right here. Notice how, yes, this candle wicked below and it went even deeper, but not until it closed did that market structure shift or change in the state of delivery happen. This candle didn't do nothing. This candle is what did it. So once that candle comes in, we can even draw your Fibonacci if you want to. You could draw it from here up to the expansion high up here, right? And look at how it comes down into that 786 area, even that half range right there. I mean, like drawing the Fibonacci is very subjective. I like objective objects, right? Which are going to be fair value gaps, order blocks, and things like that. So what you can do is you have this fair value gap right here first, right? And then you have this order block right here, right? So since there's two PDAs that price can potentially tap into, I talk about dollar cost averaging. Dollar cost averaging, if you're comfortable with risking 2%, break your 2% into two different positions, 1% and 1%. Trade your initial 1% right here. Once price taps into it, boom. Stop loss, I'm just going to put it below the order block right there. Boom. Okay. Normally it would go below the one candle of the fair value gap, or if the second candle is the longer one, but because it's a news candle, I'm not going to participate in that candle. I'm going to put it below the order block. And then the second position is going to happen if price taps into that order block. Now, we don't know if price is going to tap into that order block. It could just take off from that fair value gap and we could only be entered in that 1%. That is okay. That is business, okay? We are doing business here. Right here, it came down and it offered us an even lower price. It offered us a better price. It came to us and it was like, you know what, man? You're a good client of ours. You buy from us all the time. We're going to give you an even better price. Here, take it while you have it, while you have the chance. And boom, we took that. And so right here, we would target a 1 to 2R on the original 1% that we entered, right? And since we anticipate price to hit that, we need price to hit that. We won't claim this position unless it hits 1 to 2R. Because of that, I'm going to set this DCA position at that same take profit level. And look at how bigger of a risk to reward ratio it provides us. It gives us a 6.76R, right? So if you're risking 1%, this is going to provide you 6% return, almost 7% return. It's missing just a quarter percent, right? And that would be a 7% return and a 2% gain, right? So that right there is an 8.75% gain that you just made on this position right here. Okay. Now, because price is on the 15-minute, now market structure shifted bullish, then the 4-hour is now bullish and respecting. You can anticipate now that the 4-hour is going to create these open, low, high, close, open, low, high, close, open, low. And look at, that's exactly what they've been doing, bro, ever since. And now because price is bullish, this is the expansion leg it could retrace. And what does it retrace into? Well, hell, if we look at, if I just delete everything, right, what can it retrace into? We have this fair value gap right here. We have this fair value gap that it just tapped into as well right there. We have another one right down here. And that's also in alignment with this order block right here. Now, again, we have no idea which one of these are going to get held and respected. We just wait for price to tap into them, and then we're going to drop to the 15-minute, and we're going to look for market structure shifts bullish off of these areas. And if we don't get a market structure shift bullish, look at this. The 15-minute, we consider it bearish right now, okay? Gosh, this is so much game right now. We consider it bearish right now, okay? Because the 15-minute is retracing. Until the 15-minute does a market structure shift bullish, the 15-minute is bearish. And as it's bearish, you can see that it's retracing up into these fair value gaps, right? This is internal range liquidity right here, okay? Now get this is getting a little risky. You can look for sell opportunities right now until price market structure shifts bullish. Now keep in mind, price can market structure shift bullish at any time. We have no idea when. But until then, you can look for 15-minute sell opportunities off of 15-minute PDAs, these internal range liquidities. And how can you do that? I told you I don't recommend doing this whatsoever, but I know a lot of y'all are your own personal trader. You would drop from a 15-minute time frame and you would go to a 1 minute, and you're looking for a market structure shift bearish. Okay. And right here, you can see that whenever price is retracing up into this PDA right here, the last 3 candle wick swing low is right here. And then since then, it hasn't created one. It looks like it could potentially create one right here, right? So until then, we are going to stay patient, and we're going to wait for a market structure shift bearish on this 1 minute time frame. On the 15-minute time frame, market structure shift bullish point is up here. So until we get displacement above that high, we are bearish on the 15-minute. Okay. Gosh, that was so much game. This is a gem video. This video is so freaking good, you guys. I'm going to watch this video myself probably like 5 times, dude. It is such a good video, you guys. I'm excited to post this one for everyone. But if you got some value from this video, from my content, I'm strictly trying to focus on self-improvement, improving myself, improving, and motivating and inspiring everybody else to improve themselves as well. Like, honestly, the goals in life are to be healthy and to not have to worry about like financial struggles, bro, because like financial stress is such a burden on everybody, bro, and stress in general is just so bad for your health, for your life, for your heart. It's horrible, bro. People die from stress, literally. Not to be over dramatic, but that is real. People die from stress, bro. And to alleviate that stress by becoming financially free, financial freedom is the goal. And to focus and make your mind stronger, smarter, and to make your body stronger, healthier. All of this, bro, it leads to a better life, dude. I'm not gonna lie. Whenever I wake up and I do these morning routines and these morning habits, I woke up at 3 a.m. this morning, bro, and I got straight to it, just being productive. And that feels so good for myself, for my health, dude. And it makes me feel good about myself, these small accomplishments. But I said it in the beginning of this specific trading clip video, I am unsatisfied with these small accomplishments. I want more for myself, and I'm going to continue to demand more for myself. And you should do the same for yourself. Again, if you're not already subscribed to this channel, I highly recommend subscribing to my channel. Click on that bell so you know when I upload. Those are the notifications. Know when I upload, bro. And come and join me. Comment so I can see your name, so I can say what's up. I appreciate everybody who shows some love, and we'll see you guys in the next clip, man. Later.